To speak of the birth of banking is to step into a world where money first learned to reproduce itself without metal, where trust became more valuable than gold, and where the most powerful financial innovation was not a coin or a note, but the idea that promises properly managed could circulate as wealth. Long before modern banks rose in glass towers and central bankers spoke in careful abstractions, banking emerged, quietly, from the most human of anxieties, the fear of loss and the desire for continuity. Merchants needed safe places to store wealth. Rulers needed mechanisms to mobilize resources without constant conquest, and societies needed ways to bridge time, allowing today's surplus to become tomorrow's survival. Banking was born not from theory, but from necessity, shaped by crisis commerce, and the slow realization that money, when trusted, could move further and work harder than any caravan. The earliest roots of banking can be traced back to the temples and palaces of ancient Mesopotamia, where economic life revolved around storage, record-keeping, and redistribution. These institutions accepted deposits of grain and silver, extended loans to farmers and traders, and enforced repayment through legal and religious authority, creating a system where credit existed long before coins circulated widely. What mattered most was not the physical transfer of wealth, but the ledger, because once value could be recorded, deferred, and reassigned, it became fluid. A clay tablet acknowledging a debt could outlive a harvest, a ruler, or even a generation, binding the future to the past through obligation. In this sense, banking began as memory institutionalized an external brain for economic society. As trade expanded across the ancient world, particularly along routes like the Silk Road, these credit practices migrated and adapted. Money changers emerged in marketplaces, facilitating exchange between currencies, assessing purity, and quietly learning that information asymmetry was itself a source of profit. In Greece, trapezitai sat behind tables, exchanging coins and safeguarding deposits, while in Rome, argentarii managed payments, loans, and settlements for a growing commercial class. These early bankers did not create money from nothing, but they accelerated its circulation, reducing the friction of trade and allowing economies to scale beyond local barter and personal trust. Even then, the core function of banking was clear: to transform idle wealth into active capital while managing the ever-present risk of default. The medieval period marked a decisive turning point because it forced banking to evolve under moral and political constraints that shaped its modern form. Christian doctrine condemned usury, yet commerce demanded credit, and this tension gave rise to sophisticated workarounds that laid the foundations of financial innovation. Italian city-states like Florence, Venice, and Genoa became laboratories of banking, where families such as the Medici perfected double-entry bookkeeping correspondent, banking, and bills of exchange that allowed merchants to move value across borders without transporting gold. A merchant could settle accounts between Bruges and Florence with ink and reputation, proving that money no longer needed to travel to be effective. Trust, once localized, became networked. These banking networks did more than facilitate trade. They quietly reshaped power. Rulers who once depended on plunder and taxation now relied on bankers to finance wars, infrastructure, and administration, binding state survival to financial credibility. Public debt emerged not as a flaw, but as a feature allowing governments to borrow against future revenue in exchange for immediate capability. This was revolutionary because it meant states could outgrow their treasuries, but it also introduced a new vulnerability: dependence on confidence. When confidence held, states expanded. When it broke, defaults and collapse followed, reminding all participants that banking magnifies both strength and fragility. By the early modern era, banking had become inseparable from capitalism itself. Central banks emerged to stabilize currencies, manage government debt, and act as lenders of last resort, formalizing roles that private bankers had played imperfectly and often disastrously. The Bank of England institutionalized trust at a national scale, anchoring money to state power, while disciplining that power through markets. Credit became cheaper, capital deeper, and growth faster. But the system also grew more abstract, further removed from tangible production. Money increasingly represented claims on future output rather than present goods, and finance began to look less like a service to the economy and more like an ecosystem of its own. Yet beneath this sophistication, the ancient logic of banking never disappeared. Banks still transform short-term deposits into long-term loans, still rely on confidence to prevent panic, and still sit at the fault line between private profit and public stability. Every banking crisis from Renaissance Florence to the Great Depression to 2008 follows the same emotional arc: exuberance, fueled by credit expansion, followed by fear when trust evaporates, forcing the state to intervene and socialize losses in the name of systemic survival. Banking, for all its innovation, remains a fragile architecture built on belief, and that fragility is not a bug, but a consequence of its power. To understand how modern finance began, then, is to see banking not as a sudden invention, but as a gradual concentration of trust, record-keeping, and risk management into institutions that promised continuity in an uncertain world. Banking allowed societies to grow beyond the limits of metal and muscle, but it also bound them to cycles of boom and bust that reflect human psychology as much as economic logic. And it is precisely at this point, when banking evolves from merchant craft into systemic backbone, that the story demands we pause and look more closely at how this concentration of financial power reshaped inequality, sovereignty, and crisis itself, as banks moved from the margins of commerce to the center of modern life, and began to influence not just markets, but the fate of nations in ways their earliest depositors could never have imagined, as they handed over their silver and trusted that it would still be there when they returned. Because that leap of faith marks the true birth of modern finance. And it leads us directly into the next movement of this history, where banking's promise of stability collides with its capacity for excess, and where the line between serving the economy and dominating it begins to blur as credit expands faster than the real world it claims to represent. And the consequences of that imbalance start to reveal themselves in crises that no longer remain local, but spread across borders and generations, until the question is no longer how banking began, but how far it can go before trust itself becomes the scarcest asset of all. And that is where the next part of our journey must begin. As we follow this story into the age of central banks, financial bubbles, and systemic risk, and examine how an invention designed to manage uncertainty ultimately learned to manufacture it at a scale history had never seen before, and how societies responded when the institutions built to protect stability became sources of instability and forced the world to rethink what banking is for and who it should serve when the stakes grow too large to ignore, and the system can no longer pretend that confidence alone is enough to hold it together without confronting the deeper tensions embedded within its design. And that unresolved tension is exactly where we will continue when we move forward from this moment and step into the era where banking no longer hides behind merchant counters, but stands openly as one of the most powerful forces shaping the modern world and its future. Look more closely at what happened once banking crossed that invisible threshold, because when credit ceased to be merely a lubricant of commerce and became the engine of economic expansion itself, the balance between stability and excess grew increasingly fragile. In the centuries that followed, Banking did not simply support growth, it began to shape the very rhythm of prosperity and crisis, expanding opportunity in good times and concentrating pain when confidence faltered. The modern financial world was not born fully formed, but assembled through a series of shocks that revealed both the necessity and the danger of concentrated financial power. The 17th and 18th centuries marked the moment when banking fused with statecraft. Wars grew longer and more expensive, and rulers, who could tap deep capital markets, outlasted those who relied on treasure alone. Central banks emerged not as neutral technocrats, but as crisis managers, tasked with preventing temporary panic from becoming systemic collapse. The Bank of England's role as lender of last resort set a precedent that echoed across continents, formalizing the idea that some institutions were too important to fail because their failure would fracture the entire economic web. This logic stabilized finance, but it also introduced moral hazard, quietly teaching bankers and governments alike that risk could be socialized if the stakes were high enough. As industrialization accelerated, banking adapted again, channeling savings into factories, railways, and infrastructure that transformed productivity and living standards. This period demonstrated banking's most constructive potential because when credit aligned with real investment societies, experienced sustained growth rather than speculative illusion. Yet even here, the line between productive finance and speculation proved difficult to police. Railway manias, canal bubbles, and stock market crashes revealed how easily optimism could outrun fundamentals, especially when leverage amplified returns on the way up and losses on the way down. Banking did not create these cycles, but it magnified them, turning localized misjudgments into economy-wide convulsions. The 20th century forced a reckoning. The Great Depression exposed the catastrophic consequences of unregulated banking systems, where confidence collapsed faster than institutions could respond. Bank runs, deflation, and mass unemployment revealed that trust once broken could paralyze entire societies. In response, governments imposed deposit insurance capital requirements and monetary controls, effectively acknowledging that banking was no longer a private affair, but a public utility whose failure imposed unacceptable costs on the collective. For a time, this bargain worked. Financial stability improved, growth resumed, and banking receded from the center of political controversy. But stability bred complacency, and by the late 20th century, deregulation and financial innovation once again pushed banking beyond its traditional boundaries. Complex instruments promised to disperse risk, while globalization allowed capital to move faster than regulation could follow. Banks grew larger, more interconnected, and more opaque, recreating the conditions for systemic fragility under the guise of sophistication. The crisis of 2008 was not an aberration, but a historical echo, a reminder that banking's power to create money and leverage belief had once again outpaced the structures designed to contain it. Seen in this light, modern finance is less a triumph of progress than a negotiated truce between growth and restraint, constantly renegotiated after each crisis. Banking remains indispensable because it solves a problem no economy can escape: how to mobilize future resources in the present. Yet it remains dangerous because it tempts societies to promise more future than they can realistically deliver. This tension cannot be engineered away. It must be managed through institutions, culture, and memory, and history shows that when memory fades, excess returns. The birth of banking, then, was not a single event, but the beginning of an ongoing experiment in trust at scale. From clay tablets to digital balance sheets, the underlying question has remained unchanged: who is allowed to create money, under what constraints, and for whose benefit? Each era answers differently, but none escapes the consequences of its choice. When banking serves production, it anchors prosperity. When it serves itself, it destabilizes the foundations it depends on.